most of us here who are either retired or about to retire or accumulating towards retirement are having this theme kind of flash in our face that we need to go offshore. We can't invest in South Africa. The recency bias, looking at the last 12 years, kind of, it shows that story is true. If we look at the MSCI World Equity Index over the last 12 years versus the Johannesburg Stock Exchange, and please note this is in Rand, so it's taking Rand depreciation into consideration, it kind of supports that story that, if we go offshore, we would be doing better than if we invested in South Africa. But as we've said already, that we have to look at the bigger picture. So yeah, you can see that on the MSCI you would have 8x your money versus 3 times on the Johannesburg Stock Exchange, over 2.5 times more capital invested if you went offshore. If we look at those first 12 years, however, from the early 2000s to 2012, it paints a different picture. But if we think about what happened, in the early 2000s, think about Y2K, 2008 financial crisis, think of who our presidents were in this time period of from 2000 to 2012. The theory shouldn't have supported the Johannesburg Stock Exchange doing well, but again, we can see 6x on the JSE versus only 1.3 times on the MSCI World Equity Index. And that is only down to Rand depreciation. You only made money on the MSCI through Rand depreciation. It was actually flat for 12 years in dollar terms. So as much as we'd like to say that, when we invest and retire, we only have 12 years to invest, that's not the story. It's very much a long-term game. So looking at the whole picture, when you kind of put the two together, you can see that the JSE from the early 2000s, you would have had over 1.5 times if we had stayed in the Johannesburg Stock Exchange. Now, please don't for one second, when we show these pictures, are we saying that now when you retire, we need to just bring everything locally and invest in the Johannesburg Stock Exchange. It's not what we're saying. It's just to put things into perspective. Because unfortunately, everyone can be the best investor with hindsight. But we don't know. We don't have a crystal ball. We have no idea what's going to happen in the next 12 years. But it's important to know that we can't use, so if we look from 2000 to 2012, we can't say that, the JSE performed so well, so it's going to continue to do so over the next period. You can clearly see that it didn't. When we retire now as well, unfortunately, it's not just about the markets. There are other things that come into play, and that's obviously tax. We've got to pay it, unfortunately. So what I'm showing you here is just 2 of the taxes that you would pay when we look at now retiring and potentially externalizing our funds from South Africa offshore. So the first one is just, the example is we've got about 15 million Rand in today's terms. And this table here is relevant to someone who would retire from their pensionable funds. So when you retire, you're allowed to take 1/3 of those funds as a cash commutation, and then you're free to do with that as you wish. But the tax you would give away would be just over 1.5 million in tax, about 10% of your investable assets going to SARS. On the other side, when we look at the withdrawal tax table, so this might be someone who might be listening to certain people in the news saying that, no, you need to cash everything out, get out of the Rand, get offshore, pay all the tax because you're going to be better off. In this scenario, you can see we'd be throwing away about 5 million Rand in tax, to be able to cash it all out. Over 35% of our funds go to SARS. So what we've done is kind of to try and put this into a picture that pulls that case study together, is we've gone back to 2000 and we've said that, obviously 15 million Rand in today's terms is not 15 million Rand in 2000. It's about 4.5 million Rand. And the 2 scenarios that we've looked at, we said, investor A has retired tax efficiently, so they haven't given any money away to SARS. They've put the funds in a living annuity and invested in a multi-asset balanced fund, drawing down 5% per year. Versus someone who wanted to cash in as much as they can, to take it offshore and invest globally, We didn't use the 35% as an extreme. We kind of took a balance. They said they'd give away about 20%. Same thing, drawing about 5% per annum. So just before I show the graph, just when I talk about multi-asset balance fund, I just wanted to show the difference or the journey an investor would have had if they took that approach from the early 2000s to today. Now, we obviously heard about certain limits and regulations in the early 2000s that would have restricted the amount of access that we had to global equities, okay, and kind of forced us to invest locally. But taking this dynamic approach would have afforded the investor to obviously, as the limitations lessened and regulations kind of opened up, you gradually will have moved into a space where you would have taken more global equities when afforded to you. But again, you can see balanced approach and how some of the asset classes have changed given certain economic environments. So when we tie that together, you can see the starting point over here. Investor B, who decided to cash in, is obviously starting with a bit of a handicap. Okay? And investor A, who's gone into the balance fund approach, has enjoyed a very, very similar ride to that of the JSE over the same time period. And I found this very interesting because when you expect someone who's invested in a balanced approach, i.e. taking a little bit of risk off the table, not going 100% into equities, you would have expected them to fall somewhere in between the JSE and the MSCI over that 24-year period. But you can actually see they're also 1.65 times better off at the end of the journey. And that's got a lot to do with that dynamic approach that I spoke about. The rebalancing of the portfolios, as the asset manager decided that it was time to cash in some profits, maybe move some from local to offshore, that would have afforded investor A to not only have a more diversified multi-asset approach to their investment, obviously de-risking the fund, but still afforded them the opportunity to benefit from the returns available to them from the markets.
So we've spoken a lot today, and I think what's typical of a lot of these presentations is that, investments will often look point to point. We kind of, where do we start and where do we finish? But the reality is that probably other than the ladies in the room here, none of us are Sleeping Beauty. None of us are going to start somewhere, wake up down the road and have a look at what did this thing do. It's the experience along the way. So oftentimes where your portfolio will land up long term can be a consequence of something called this sequence of return risk. Yes, we've seen good examples today of kind of a split between the 2 decades since the start of 2000, where one market sector has outperformed another. But often it's because we are looking at this from a, let's call it a retirement perspective. We're not investing, leaving this alone and not touching it again. This example here has assumed that this investor's been drawing 5% of their gross portfolio on an annual basis paid to them monthly. So what it is, well, they're not simply leaving it alone, they are drawing an income. And that income is going to give them an idea of, well, what kind of life have they experienced over this period? So on a gross basis, if you take that blue line, which is that so-called balanced fund composite that we looked at, cumulatively in rand terms, you would have drawn about 18 million rand over those 24 years of income, right? Versus if you had been able to externalize into a global index, just track the world, you would have drawn about just short of 6 million rand, okay? So, a significant difference there. But a lot of clever people will say, hang on, that's gross. What about tax, okay? Now, the problem with tax is that, we ultimately need to pay it, all right? The tricky part is we've got to decide, well, when are they going to steal it from us and how often? So if we look at a living annuity structure where that's locally domiciled, we know that within that investment vehicle, all the returns are tax exempt. However, the income that we draw out of it is subject to PAYE income tax, as if we were earning a salary. Whereas if we had gone and externalized, we had basically paid all the tax up front and just put things into a discretionary investment. So here we put it together, we're now paying, we're earning some interest and some dividends within our portfolios. When we're drawing an income, we're liable to pay some capital gains tax. What does that all eventually look like? So coming back, well, that's the gross. So what we said is, okay, fine. If we had to tax ourselves at, let's say, a flat rate of 25%, so put in perspective today, that's an effective tax rate of 25%, you'd probably have to be drawing about 65,000 Rand gross per month from your living annuity, versus typically when you're in a discretionary type scenario, you're paying around about 10% in tax, once you overlay the various taxes within the investment and managing the capital gains tax. So if we apply those, now we sit in a situation where, well, let's call it my local balanced fund living annuity, I've drawn a net income of just short of 14 million against an effective income on the global side of just over 5. So still a significant difference between the two, even when we factor in the tax along the ride. Now, if we push the pedal to the metal, because there's a lot of concern around what's going to happen to tax rates, are there going to be wealth taxes, etc., etc. Well, the best example we can look at now is to say, let's exaggerate this, push it all the way up to a 45% tax on the income that you take. And even when we roll that out and we assume that from day one you've been taxed at 45%, so you might have that situation where outside of your living annuity, you've maybe got some rental income, maybe you've got a business that you're still operating, any other income that's possibly pushing up your total taxable earnings for the year, and you're drawing at 45%. You're still in a situation, certainly over the last 24 years, and obviously history is never a perfect kind of predictor of the future, where you're nearly twice as better off in terms of income. So just think about the lifestyle that would have afforded you during retirement. So I think a lot of the time we look at it and say, okay, fine, but look at this fact sheet, look at this performance, look at that performance, and we really need to consider the effect of what tax is going to do, not only at retirement, but during retirement or during any investment period. And then I suppose we've also got to consider the fact that these two portfolios are going to be taxed very differently when you pass away one day. The estate duty consequences are going to be very difficult, very different, and significantly more on a more discretionary portfolio.